The U.S. Federal Reserve lowers its benchmark interest rate by 25 basis points to mark the first cut since last December, amid concerns of the labor market and economic growth. With more on Press Perspective. Hello and welcome to Press Perspective for this Friday, September 19th here in Seoul. I'm Min Sunhee. Today we start with the U.S. Federal Reserve's rate reduction and the reasons behind it before moving on to its ripple effects on the stock market and trade talks between Seoul and Washington. For more on this, I have Celio Fioretti with French daily Croix here in the studio. Celio, welcome back.
Glad to be here.
I also have Professor Oh Joon-seok at Sookmyung Women's University live on the line. Professor Oh, as always, it's great to have you with us.
Good evening, Sunny.
Right, we'll start here in the studio. Celio, let's start off then with a recap, perhaps, of the U.S. Federal Reserve's latest policy decision and its implications.
Yeah, exactly. The U.S. Federal Reserve made an important move this week by lowering its benchmark interest rate by 1/4 percentage point and signaling that 2 more cuts might be happening before the end of the year. This was widely expected but still gives markets a lot to digest. Fed Chair Jerome Powell described this week's move as a risk management cut, noting that the balance of risk facing the U.S. Economy has shifted. The labor market is cooling, while the inflationary pressure is rising, particularly from the rising price of goods imposed by the tariffs that Trump made over the last year. And so all of this pressure is building, and consumer price rose 2.9% in August, the highest since January. So the pressure is real, and Powell warned that the inflationary effects from tariff could continue well into next year. Despite President Trump's push for a more aggressive easing, Powell made clear that there was a little appetite among policymakers for a half-point cut, saying that the current pace of policy adjustment is appropriate for now. So the significance here is twofold. First, the Fed is trying to safeguard growth as the labor market slows, but at the same time, it's keeping a close eye on inflationary risk that could worsen if tariff comes higher in the months ahead.
Right. Professor, Celio did touch upon this, but what do you believe drove the decision for the rate cut? And what are your thoughts regarding the timing of the rate cut? I mean, some claim it was timely, others insist it was long overdue. What are your thoughts?
This first rate cut since last December is expected to kick off a series of additional reductions, which should help bring down borrowing costs and which may help increase bank loans, housing loans, and purchase power in the market. As to the timing of the rate cut, I could say 25 basis points down would be a timely decision. By the way, what the rate cut means in economics, while you drive a car, finding a gas station, there is a lever on the pump panel. That is called the interest rate. When you start to lever down pumping fuel into an engine, that's the rate cut. Before you down the lever, you should check the gauge in your car and whether the engine is off and so on. If not properly treated, exposed to risk, you may spill over the fuel on the floor and the car might go into flame. The risk factors of rate cut might be at this time, and mainly 2 things: inflation and unemployment. Inflation ripped through the post-pandemic economy and prompted the bank to raise interest rate in 2022, which has recently come down significantly. But it is also true that in recent months, inflation has ticked higher and higher. As Mr. Celio commented, price rose 2.9% over the 12 months, the fastest pace since January, and still above the Fed's 2% target rate. And next, the unemployment rate. It remains low at 4.3%. Not a bad economy, however. When I borrow Jerome Powell's expression, from a policy standpoint, it's challenging to know what to do. There is no risk-free path right now. Mr. Powell's accounting another risk factor. Even the job market seems solid. What is worried about is that is Trump. Trump's economic policy, including tax cuts, tariffs, and mass detention of migrant workers, might cause inflation to flare back up again. In many ways, it is no surprise that Fed sets interest rate independent of the White House cutting by 25 basis points. Very timely and cautious action, I might say.
Right. Now, earlier, before the actual rate cut, Celio, anticipation over a potential cut actually drove stock markets here as well as those abroad to new highs. Could you walk us through the rally that the local stock market, that is the South Korean stock market, saw this week?
Yeah, it's quite a positive news. Actually, this week's South Korea stock market has been on an impressive run, hitting a new all-time high and marking 10th straight session of gains. The benchmark Kospi closed Monday at a bit more than 3,400, surpassing the record set just last Friday. The main driver of this rally was the government decision also to scrap a planned capital gain tax hike on equity holders. Officials had considered lowering the threshold, but investors worried that the move would hurt the demand. And by keeping the bar at 5 billion won, the government reassured markets and reinforced confidence in domestic equities. Foreign investors were especially active, buying more than 260 billion worth of shares, while local institutional and retail investors locked in some profits. The steady inflow from abroad also helped sustain momentum and highlight Korea's relatively low level of foreign ownership, leaving room for maybe more foreign ownership in the future. Investor sentiment also benefited from global factor, as you said, with the U.S. Federal Reserve meeting planned for the week. Expectation of a possible rate cut have boosted appetite for risk assets across Asia. And the backdrop has added fuel to the rally, even as some sectors like auto and shipbuilding lagged. But overall, I would say strong performances in tech and chemical stocks, especially in Korea, combined with policy stability and foreign inflows, have kept Kospi winning streak alive over the last 10 sessions. And while analysts do caution of a potential volatility and after such sharp gains, for now the rally reflects growing confidence in South Korean stock market.
Right, and staying with the stock market, Professor Oh, my next question to you is actually the title of a recent article by American news agency UPI. Will the South Korean stock market overcome the Korea discount? And of course, Professor Oh, could you start off with a quick definition of that phrase, Korea discount, for the sake of our viewers who may not be familiar with it?
Even though it is not academic terminology, Korea discount refers to the tendency of Korean stock to be undervalued compared to global peers. I believe a market is very, very honest, but value is aggregated sum of expected cash flow over discount rate. Even though the sum of cash flow is equal, as discount rate of Korean stock is higher than peer group, so the value of the stock becomes undervalued. The higher discount rate by global investor makes Korea discount. Discount rates are made by risk-free rate plus risk factors. As risk-free rates are equally constant, higher discount rate comes from higher risk factors, which is surrounded by Korean stock market, measured by global investors. What makes higher risks when global investors enter Korean market? Korean government has tried consecutively to deal with Korean discount by revitalizing the capital market. In response, the voluntary plans have been submitted under the government-led corporate value program. All top 10 business groups in Korea, including Samsung, SK, Hyundai Motors, have submitted plans to boost their corporate value. That appears to be working, as shown by the strong share price in recent months. The Kospi-listed companies that have submitted such plans spiked 34.1% on average in January-August period. Could it be continued? I doubt. That is because market is always much smarter and more desperate than government. Political gestures could burst emotionally into tears and give affirmative signals to global investors, but there should be a limit to gain confidence and capital from the global investors. What is needed most? Korea shows more concrete evidence of transparency, trust, and stability of the Korean capital market more than anything else.
Right, transparency and stability then. Celio, moving forward, Trade Minister Yoh Han-gu is back in the country following his latest trade talks with officials over in the US. What's the latest with regard to tariff trade talks between Seoul and Washington?
Talks between Seoul and Washington remain tense, but still ongoing. And South Korea top trade negotiator was in Washington this week to follow up on the 350 billion investment pledge, even as controversy still lingers over the recent U.S. immigration raid at a LJ Hyundai plant in Georgia. To recall, more than 300 Korean workers have been detained in that raid, and also they've since been released. Still, the incident has fueled a lot of criticism in Seoul over to know if really it's worth it to invest in the U.S. anymore. And the negotiations for now are focusing on the trade deal that was reached back in July between Seoul and Washington. At the moment, at the summit in the White House, nothing has been signed off, even though both leaders pledged foreign investment. So the details have to be negotiated now, and President Trump has yet to issue an executive order to effectively lower the tariff, leaving Korean officials reluctant to commit further without clarity on enforcement. Washington has been pushing Seoul for a Japan-style arrangement, as they done with Tokyo. Tokyo had a $550 billion pledge of investment, but South Korea insisted that those terms are simply not feasible for the Korean economy. Official argues that the Korean economy is smaller and that investment could destabilize currency markets. Critics add also that simply paying higher tariff might be cheaper than actually investing in the U.S., considering the whole political turmoil these days. And at the same time, Seoul has signaled that the immigration rate will remain on the table and will need to be fixed if the relationship wants to go further. Korea must defend the rights of its workers and find a solution for this visa situation if they want Korean company to invest in the U.S., build factories there, and bring their workforce there. So for now, there's a lot of tension, a lot of political sensitivities between Washington and Seoul. Still, talks remain ongoing, and we'll have to wait a bit more to see a final conclusion.
Right, and staying with this issue, Professor, Reuters has pointed to the foreign exchange implications of the $350 billion investment fund as hindering trade talks between South Korea and the U.S. Could you explain this for us, Professor Oh?
More than anything else, the characteristics of economics, as well as the size of economics, Korea cannot be compared with that of Japan. In case of Japan, the $550 billion pledge to invest in the United States in exchange for a lower tariff. Tokyo agreed to transfer money within 45 days after the U.S. select a project, and that available free cash flow from investment would be split evenly until they reach an allocated amount, after which 90% would go to the United States. And the United States request the same and equal decision from Korea. But Korean officials had argued that the package would mostly comprises loan and guarantees, which limited direct investment, and they could not accept the terms similar to those of a $550 billion investment package finalized this month by Japan. Korea's economy much smaller than Japan's. It had a current account surplus of $99 billion US dollars last year, compared with Japan's surplus of nearly $200 billion US dollars, and then central bank's foreign reserves of $415 billion in August. Korea had experienced the deep impact of financial crisis. Since suffering traumatic capital flight in the late 1990s, Korea has retained a tight grip on its currency market. It started opening to foreigners, but there is still no offshore market to trade the won. The status of Korean won is not a key currency, while Japanese yen is widely used as a key currency, which implies Japan has more reserve to resort when it's needed to handle the foreign exchange shock, but Korea has not. Market experts say that 40 billion US dollar needed by the state pension fund every year for its overseas investment is already a heavy burden. So it is expected that the investment package will generate a dollar demand of around 100 billion US dollar each year from 2026, which is beyond the affordability of the Korean economy. At least Korea needs more time to prepare for risk management, for example, swap contract with other countries, and the affordability of the economy should be treated definitely differently from that of Japan.
I see, which is why Celio was saying there were some critics who were saying it's better just to pay the 25% tariff to the US. Right, and staying with trade, Celio, there's also been quite a bit of media coverage here in the country about South Korean autos losing their competitive edge to their Japanese counterparts in the American market as Japan sees a lower 15% tariff while South Korea sees a 25% tariff. Could you put this reality into some perspective for us?
Well, this really highlights how much tariffs are impactful on local economies. In the US auto market, starting Tuesday, Japanese car will see tariff fall from 27.5% to 15%, while Korean automakers will suffer still 25% amid the stalled trade negotiation, as we just mentioned. On paper, Korean cars should be cheaper. For example, the Kia hybrid retails at around $30,000 compared to $32,000 for a similar model in Toyota, for example. But once you apply those tariff rates, the Kia model becomes more expensive than the Japanese one, which force companies like Hyundai, for example, to absorb cost and sacrifice profitability if they want to stay competitive in the US market. This is particularly tough timing because Hyundai and Kia have been expanding aggressively in hybrids. Their US sales climbed to around 90,000 units in 2021 to more than 220,000 last year, and they're already up nearly 50% this year. So they really invested a lot and they expect a return of this investment. But Toyota and Honda, the Japanese brands, still dominate the market with a combined 68% of shares in the US market, which just compared to just 12% for Hyundai and Kia for now. Looking ahead, Hyundai does plan to build a hybrid production line at its site in Georgia, but that won't come until next year and maybe even more delayed with the current issue. And because meantime the company is grappling with US restriction on immigration and the whole visa situation. So in short, for now, tariffs are giving an edge to Japanese companies, and South Korea also needs to reach a deal with the US quickly if they don't want to lag too much in the competition.
Right, and against this backdrop, Professor Oh, the South Korean economy is expected to grow less than 1% this year. What are your prospects? I mean, do you envision, Professor, a further downward revision, or do you see the possibility of an upward revision before the end of the year? What are some of the variables, if you will, that you believe that you would like to highlight with regard to our economic growth for 2025?
Thank you, Sunny. The Korean economy is projected to grow by 0.8% in 2025, weighed down by a contraction in construction and deteriorating trade conditions. So there is a slim chance of overdue revision. Korea faced a double whammy in the second half, declining domestic consumption inside and trade uncertainty outside. In the July-December period, there is a projection while auto parts and machinery industry could see the drop of 6.5% and 3.8% respectively due to U.S. tariffs. Domestic demand has yet to show meaningful recovery as political instability continues to weigh on consumer sentiment. Growth in private consumption has slowed, particularly in service sectors such as accommodation and food services. Meanwhile, the downward pressure from high interest rate and sluggish construction orders suggests that the weakness in domestic demand may moderate over time with a lag. What about external soundness? It really matters a lot for Korean economy, which accounts to nearly 60% of total GDP. However, export conditions have deteriorated sharply as the U.S. tariffs were raised on a wide range of products, and therefore trade-related uncertainty has risen to an unprecedented level. Despite the robust semiconductor export until recently, overall export has weakened amid sluggishness in other sectors, and the conditions are expected to deteriorate further following the U.S. tariff hike. In light of these domestic and external circumstances, the Korean economy is projected to face slower growth than expected before, and then there is a slim chance of upward revision. Considering the continued decline in Korea's potential growth trajectory, now is the very time to maintain a policy of a structural economic reform to enhance the competitiveness of the Korean economy.
Right, I see. On a more optimistic note, Celio, Hyundai Engineering Construction, it recently secured a seawater treatment plant order from Iraq. Could you tell us a bit more about this order and its significance?
Yeah, this is a very significant deal for Hyundai Engineering and Construction. The company just announced it has won a $3 billion contract to build a massive seawater treatment in Iraq. The project is part of Iraq Water Infrastructure Program, a state-led initiative to support the oil production of the country. The plant will be located in Khor al-Zubayr port, about 500 kilometers southeast of Baghdad. And once completed, it will be able to transfer water to the oil production point, the bigger one in the countries in the south, because the country, Iraq, is planning to double its production of crude oil by 2030. The construction is set to begin in November and should be completed by the end of 2029. The project is being led by a French company, Total Energy, in partnership with Qatar Energy and Iraq Basra Oil Company. This contract represents Hyundai's second largest contract in Iraq, after the $6 billion refinery project in Karbala completed last year. For Hyundai, this not only consolidates its presence in the Middle East, but also become more trustful for the country, and also can gain experience from partnership with other companies. And in the coming years, maybe we'll see more projects coming from Hyundai in the Middle East.
Right, hopefully. All right, Celio, thank you so much for that optimistic piece of news, as always. And Professor Oh over at Sookmyung Women's University, as always, thank you so much for your insights. We greatly appreciate it.
Pleasure is mine.
Right, that ends this edition of Press Perspective. Do have a great weekend and do join us again next Monday. Thank you for now.